Here's something strange happening with Oracle right now. The stock has fallen 52% over the past year. That's more than half its value. Gone. And yet the average price target from 44 different Wall Street analysts sits at $248, which is over 100% higher than where the stock trades today. So, which story is true? Is Oracle a company in trouble or a company that the market has badly misunderstood? Let's dig into the numbers and let them tell the story. Oracle is currently valued by the stock market at $346 billion. That's called the market cap, basically what all its shares are worth combined. But there's another number that tells a deeper story, the enterprise value, which sits at $480 billion. Enterprise value includes debt, and the fact that it's so much higher than the market cap already hints at something important we'll come back to. Before we get there, let's talk about who actually owns this company. Insiders, meaning company executives and board members, own over 40% of Oracle. Institutions, the big funds and pension managers, own another 43%. That means the vast majority of this company is held by people who are deeply invested, literally and financially, in its future. That's not something you see with every stock. Now here's where things get interesting. Oracle trades at a price-to-earnings ratio, or PE ratio, of 20.57. In simple terms, that means investors are paying about $20 for every $1 of profit the company makes each year. On its own, that number doesn't mean much. But looking forward, the forward PE drops to 14.89, meaning the market expects profits to grow. And then there's a number that often gets overlooked, the PEG ratio, which compares the price to both earnings and growth, sitting at just 0.52. Generally, a peg under 1 can suggest a stock might be cheap, relative to how fast it's expected to grow. That's the first clue that something doesn't quite add up with that 52% price crash. But at first glance, that growth story sounds impressive. So why would a stock like this fall so hard? This is where investors often get confused, because the answer isn't in the income statement, it's in the balance sheet. Oracle holds $31.89 billion in cash. Sounds like a lot, right? But it's carrying $167.43 billion in debt. Subtract one from the other, and Oracle actually has a negative net cash position of negative $135.54 billion. That works out to negative $47 per share just in debt exposure alone. And that's not even the most surprising part. Look at the debt-to-equity ratio, which compares how much the company owes versus what shareholders actually own. Oracle's debt-to-equity sits at 3.89. That means for every $1 of shareholder equity, the company has almost $4 of debt sitting on top of it. That is a heavily leveraged company, meaning it relies significantly on borrowed money to operate and grow. But here's where the story flips again. Return on equity, which measures how much profit a company generates from shareholder money, is sitting at an eye-popping 53.38%. That's an extremely high number. However, high leverage often inflates return on equity because there's less actual shareholder equity in the equation to begin with. So when we look at return on invested capital instead, which accounts for both debt and equity, the number drops to a more modest 11.48%. Same company, two very different stories depending on which lens you use. Let's talk about cash flow, because this is where things get genuinely revealing. Oracle generated $31.98 billion in operating cash flow over the past 12 months. That's real cash coming in from running the business, but the company also spent $55.66 billion on capital expenditures, which is money spent on physical infrastructure and long-term investments. When you subtract that spending from the cash coming in, Oracle actually posted a negative free cash flow of negative $23.69 billion. In other words, more cash is going out the door for long-term investment than is coming in from operations. Now, does that mean Oracle is unprofitable? Not at all. In the last 12 months, the company brought in $67.36 billion in revenue and kept $16.98 billion of that as pure profit. That's a profit margin of over 25% and a gross margin of nearly 66%, meaning for every dollar of sales, Oracle keeps a large chunk after covering the direct cost of its products and services. So the company is clearly profitable on paper. It's simply choosing, or being forced, to spend heavily elsewhere. This is where investors often get confused between profitability and cash strength, and they are not the same thing. A current ratio of 1.12 tells us Oracle can currently cover its short-term bills with its short-term assets, but only barely above the line where that becomes uncomfortable. And there's one more number worth pausing on, the Altman Z-Score, a formula designed to estimate bankruptcy risk. Oracle's score is 2.18. Anything under 3 is generally considered to signal increased financial risk. That doesn't mean collapse is coming, but it is a flag that shouldn't be ignored. However, one number changes the picture yet again. Despite the stock falling 52%, short interest, meaning the percentage of shares that traders are betting against, sits at just 1.74% of shares outstanding. If professional traders truly believed this company was in serious danger, you would expect far more aggressive short selling. That's simply not happening here. And let's not forget the dividend story, because Oracle has increased its dividend for 12 consecutive years, currently paying $2 per share annually, a yield of 1.66%, using just over a third of its profits to do so. That's a company still committed to rewarding shareholders directly, even while spending heavily on growth elsewhere. So where does that leave us? On one side, you have a company with strong profit margins, a long streak of dividend growth, heavy insider and institutional ownership, and analysts projecting revenue growth of over 39% and earnings growth of over 27% across the next 3 years. On the other side, you have a company burning through free cash flow, carrying a debt load nearly 4 times its equity, and sitting in a bankruptcy risk zone, according to one widely used financial formula. Both of these stories are built from the exact same set of numbers. The real question is which side of that story ends up shaping Oracle's future: the profitable, dividend-paying giant that Wall Street still backs, or the heavily leveraged company spending faster than it earns? What do you think happens next?